What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, guys, we are about to potentially tie another record. This has only happened twice in the history of the market since this has been tracked. I'm going to go over exactly what it is and lay out what is happening the rest of the week so you can prepare. Let's get right into it. First off, today's market was green, a little bit choppy. The levels that we played off the pre-market high and lows were beautiful for multiple intraday plays. The SPY did gap up just under 2%. However, and I talk about this all the time, low volume, 67% of your daily average volume, just under 75 million shares traded. Anytime you see price movement to the upside when volume is retracing, that is a bearish indication. We do have a couple things happening this week. You take a look at our economic calendar. And tomorrow we have Jerome Powell. He's going to be speaking at 12:20 Eastern Standard Time. We also have new home sales at 10 a.m. Followed by Wednesday, 2 p.m. is the FOMC minutes. Now, the minutes are just a written recap of the previous month's statement, what was said, but investors will look very, very closely now that it is on paper to make sure no words are misconstrued. And everything that they stated is still in line with their written obligations and written outlooks going forward. It's a time where the market just tends to get a little bit slower. And like I said, investors are looking for that confirmation. However, the problem is whenever there is movement to the upside, like I said, or it's slow, it's the shorts continue to capitalize, okay? But here's where things change. Take a look at this graph. This was posted by somebody inside the group earlier today, as I did see this floating around the internet, and maybe you have as well. Last week, we had 6 red weeks in a row for the S&P 500. We take a look at SPY. We jump over here to the weekly chart, and as you can see, there was 6 red weekly charts. It was just time for a bit of a relief bounce. We've been talking about it. All right, you've watched it happen as of January, and actually say late December. When we started to pull back, we got a couple of these relief rallies. The end of March was beautiful after we came down for so long, but we haven't seen any of that. Well, like I said, we're getting to that record territory. If you zoom in and look at what happened in 2020, there was only 5 red weeks. So the record is 8 weeks in a row. That has only happened at 2 other times, 2001 and 1970. Okay, so we are testing that very, very oversold territory. In a bigger picture, for everybody who is dollar cost averaging, for who is looking for a long-term portfolio to be able to add to them or begin starting to dollar cost average into one, you can see there is a lot of green after these heavy pullbacks. There obviously are a couple years that stand out. The first one is going to be 1931, which was pretty much when the Great Depression began in 29 and went all the way up until 1939. Very historic time in history. Obviously, the market took a huge beating. The entire economy of the United States took a huge beating, during that time frame. Next, you look at 2000 after the dot-com crash. The dot-com crash is a little bit different in my opinion, and I'm going to go over just briefly why. I see a lot of people comparing what's going on now to 2008 and 2000. Couple of things that were different, especially with 2000, is one, these tech stocks were definitely overvalued. They were, definitely bid up high, just like what's happening now. However, we're a little bit different of a time. We've proven that we are in a technological era. All right, you speak to my father and even some books that I've read, and even watching, old, TV sitcoms that were talking about, okay, the stock market when it comes to that time frame is. There were individuals that thought email was a fad, that the internet was never going to take off. All right. You hear the stories of Jeff Bezos starting Amazon, that it was just never going to happen. All right. People were so set in their ways that seeing this change, the vision wasn't really there. However, the vision is proven as of now, and knowing that Tesla is going to continue to innovate, and Apple and Microsoft and Nvidia, those are not speculative, even though they are trading at high valuations. Yes, some companies, okay, that went to astronomical numbers. All right, such as Upstart up to 400. Okay, going through COVID, they might not get back to some of those highs. There will be some of those high growth speculative stocks that ran, but we're talking about those core solid companies. Very, very different when it comes to 2000. When it comes to the cyclical patterns and how stock charts run, that can have a very, very good similarity. But my point of the matter is, you see there is a lot of green coming out of it, these heavy down red weeks. So going forward in a very short term, we're about to hit 8. We haven't hit 9, looking for a bit of a relief bounce to happen very, very shortly. Okay. Next thing I do want to talk about is this right here. This is the reverse repo. It hit $2 trillion for the first time. And I first started covering the reverse repo, I think it was August and September of last year. And this is something that's a little bit new to me because it wasn't, it wasn't something I looked at and monitored, investing, previously. However, after doing some research and talking to some individuals that have been in the game much longer than I have, they really said two things that stood out to me. The first thing was that it is not a good sign when the Federal Reserve is offering this. And basically, they need to raise capital in order to offset their balance sheet. So you could basically pretend going to your friend or your friend coming to you and saying, listen, can I borrow just $1,000 to put it into my account overnight just to make sure I hit my minimum daily balance? And then tomorrow I'll give it back to you. Hopefully I'll make some money. Maybe there'll be some changes, maybe not. And then I'll just continue asking other people. It's exactly what it's like. The second thing, and I said this from like that September timeframe, was big institutions do not trust where the market is going long term. It is more beneficial for them to be able to park their money overnight, get these very minimal returns because it's guaranteed. All right. And seeing where we've gone all the way from when the SPY was sitting up at that 450, 460 level when this first started, interest rate, quantitative easing didn't even have a time frame when it was going to end. There was nothing about raising rates or what it was going to be look like or when, quantitative tapering was going to happen. Okay. And it's all happened and you see it just slowly rise and rise and rise. And it's kind of cool to see how the market has pulled back because of this direct effect and where the institutions were thinking, knowing that obviously we're going to get a pullback inside the market. So I continue to monitor this number, not as closely as I used to, looking for that subtle change to the downside to when you start seeing these funds looking at these quality companies that are just beaten down. The average PE, as I talk about this as of recently, is between 20 and 25. We are sitting about 16.8 to 16.9 for the entire S&P. And that's getting to a very, very good valuation going forward. Last thing I want to talk about before we take a quick look at the charts is this article right here. This is where things can get really ugly. The reason why I'm saying this is because we're at a time frame where baby boomers have retired, maybe some are still working, already starting to retire, and they have massive 401ks. And when you go to your financial advisor and you're looking and you're saying, listen, I'm going to be retiring soon, I'm looking for a little bit safer of an investment, financial advisor might say to you, okay, let's pull a little bit out of equities, okay, and go a little bit heavier into bonds. Reason being is because when your equities start to crash, your bonds a lot of times will tend to rise. So your portfolio is a little bit offset, meaning the market could be down 15, 20%, but your portfolio is only down 8 or 10% because you're offset in some bonds. However, bond prices have been in a free fall for about 5 months. And there's going to be a time frame potentially coming very shortly if we don't see any bit of relief going forward, where individuals that are very, very close to retirement, if they have not done so already, are going to say, you know what? I've already lost 10%, 15%, 20%, whatever it is that I'm down from my highs, but I'm comfortable with that monetary value that I need to be able to pull. Because if it gets any less, I'm either going to have to work longer or go back to work, which some of those individuals might not be an option, especially if they're 60, 65, 70 years old, and they really have just started to get out of their retirement era. So that is one thing I am looking forward to, or looking very closely to going forward. Let's take one little look at the charts. As you can see right here, zooming in on the SPY for the weekly, we did have a little bit of a green candle, and it is going to be nice just to see a little bit of green to be able to end the streak going forward. However, look for these next 2 days to pass by, see what Jerome Powell says going forward. All right, the 5-day, 5-minute chart is still looking like it does want to get above, try to test above that 400 area, possibly getting back to 409. But the key indication, I say this all the time, volume precedes the price action. So keep an eye on the volume. Anytime you see like what we saw today, low volume going forward. All right, I had taken this line or this price level off of this wick up here. All right, as of the previous day, I always play those levels: pre-market high, pre-market low, previous day high, previous high low. And as you can see, we're just waiting for that short opportunity to bring it right back down to the VWAP. Okay, because you saw that declining volume with the price increasing is just a bearish sentiment going forward. So guys, that is it for this video. I'll see you in the next one.